Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated, her website jugglingdynamite.com. Welcome back to the show, Danielle.
Hey, happy Halloween.
Should corporations be paying more in taxes?
Oh boy, should they ever? This is a very, very contentious topic at the moment, but it shouldn't be for anybody that can see math. We're in the middle of a global pandemic which has shut the whole world economy down into the worst recession since the 1930s. And if you look at the math of the thing, we've had declining corporate tax rates all over the world. Every OECD country except Chile has cut the corporate tax rate since 2000 multiple times. In the case of North America, for the general corporate tax rate was above 50% in 1982, and it's currently 26%. In the U.S., the Trump administration, when they came into power in 2017, they cut the corporate tax rate there 40%. They reduced it by 40% from 35% to 21%. And the whole, trickle-down nonsense was that would somehow, boost the economy and that they'd recoup, they'd collect more corporate taxes as a result of businesses doing better. Well, of course, that didn't happen, and corporate revenue receipts were actually down 30% in 2018, and have declined ever since. So there's been a direct correlation between the gap, the gaping hole in the budgets, the deficit, which has been, compounding over the past many years, with the cuts that have gone and the subsidies that have gone to the corporate sector. Now, the logic or the argument is always, well, we're job creators. But in reality, we've seen automation and offshoring have dramatically reduced the amount of jobs that the largest corporations, that the multinational corporations are offering in the population. I mean, today, as just one example, Exxon has announced that they're cutting 15% of their workforce, some 1,900 jobs. And they're doing that, why? So they can maintain the dividend to the shareholders. So this is the very nub of the matter. We have this protected class of corporations, the largest ones. Meanwhile, 2/3 of the jobs in North America come from companies that employ less than 100 people. So these are the mom and pop shops, right? The smaller companies that are basically often started by, a founder or an entrepreneur, runs the thing, looks after their balance sheet, has to keep their debt under control or they go out of business, reinvests in their community, all this good stuff that is the fruits of legitimate businesses in an area. But we don't have that in the largest companies. Right now, they've got away with, as I say, this dramatic leap in their net income because they haven't been contributing enough to the public purse. We've got this massive amount of debt globally at every level of government. Politicians are falling over themselves to try and give the most generous deals because in a globalized world, countries like the South of Ireland, for example, started this whole mess, a couple of decades ago when they began slashing corporate rates there to attract businesses. And so, it was the race to the bottom then, so every country had to kind of follow suit to cut them less and less and offer them more and more. And so, it's been great for corporate profits, and we saw that corporate profits as a percentage of GDP went to an all-time high this cycle. But this is a mean reverting series, and it cannot continue in this way because we can't fund the infrastructure. There is a vested interest. Every one of our companies, small or large, is benefited from the solid infrastructure in the community and society in which they work that supports their customers, that supports their workers. So there's a minimum tax rate or a minimum tax that needs to be collected as a fair contribution to that pot. And so that plus the investor class, getting, dividends when companies frankly should be reinvesting themselves to transform their business model for the future so that they have longer term better prospects. But instead, we've got a whole preoccupation with how do we, game quarterly earnings, how do we boost share prices, how do we get capital out, extractive mentality rather than giving to get. So all of this is part of the cancer that is now eating us in terms of the economy, in terms of prosperity, in terms of the finances of, the world. And I really think we're at a tipping point. So if Donald Trump is elected next week, he is intending at least or has talked about cutting tax rates further. This from an administration, by the way, which has increased, let's go before COVID. Before the pandemic started, in the first 3 years of their administration, they increased the national debt by 16%. This all started, frankly, with back in, the first Iraq War, and the Afghan War in 2003, when George W. Bush cut taxes at the same time as he launched America into these trillion-dollar expenditures in overseas wars. This is the exact opposite of the mentality that we've seen historically. If we look back at the history of how things worked, in the First and Second World War, for example, taxes were instituted, were brought in to pay for the war effort, right? There was this sense of this contribution factor. So not just in the conscripting of the young people, which happened in both of those wars in Canada and in America, not just in conscripting the young, but in actually conscripting the capital of the country, right? How do we fund this thing? And so they began to introduce, that's how Canada, for example, got an income tax for the first time, was in the First World War, because they were bringing in a conscription against young people finally in 1917, and there was pushback because most of the people didn't want to go fight this war. And there was sort of a thing of, hey, the wealthy people have been buying the bonds in contribution to the war effort, but we've been paying them 5.5% interest while they're doing that. Meanwhile, these young people are sacrificing their health and their life, without any of that kind of compensation. So you really got this idea of when we have a war effort, we need to all contribute, and that's how taxes were brought in specifically to fund things. So that, has continued, except in the last, 30 years, where there has been this expectation that the companies shouldn't have to contribute, that their very presence alone is enough of a blessing. And this is just, run to the end of all sort of, sanity. And so I think in this next wave, as we've got so much debt and deficit now, we've got so much, never mind the whole reinvestment that had to happen even before the pandemic, right, to reinvent so many of our business models and reinvent and, change the economy and the structure for the 21st century. We had a huge amount of war effort level investment that needed to be made then. And now, of course, we've got this added level of all of the pandemic spending that's gone on. So really, crisis is what brings people to sober math typically, and now is the time when I think that the free rides are over.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Danielle Park. Danielle, are the equity markets in for a big correction now or anytime soon?
Well, part and parcel with these themes, if you think about it, there's a few things at work there. But again, we've been through this period where corporations have got away without, these are the publicly traded, the largest corporations, the ones people buy and sell shares in, have got away with this unsustainable pattern of lower and lower costs and higher profits and less tax contribution. So if we're coming to the end of that road, and we've got a lot of initiatives and proposals internationally for, a digital tax on some of the internet giants who have largely escaped taxation, and also just generally speaking, this whole pushback that's going on in the world, where they're realizing that it's not fair that companies can just land their corporate office in the Cayman Islands, and yet all their customers and employees come from these areas where they're not contributing to the pot. So there's new proposals, and Canada, frankly, has been doing this for interprovincial taxation for many years. So we actually have a model of how this could be done on a global level. And so there's all sorts of that stuff in the works. So the theme there is going to be that we're in a more challenging business environment. We're in a more challenging time for governments, certainly. We're going to see rising tax rates if history is any guide, and it should be, frankly, because we're coming from, as I say, a very low base rate here. Depending on where you are, if we're coming from very high taxation rates, then there may be a case to be made for cutting them and allowing more reinvestment to help boost the economy. But when you're coming from a very low base rate, that is, not going to help. Cutting taxes further on companies is not going to help. So this is partly why shares are so dramatically overvalued. It's partly about this, the credit bubble, which has buoyed spending and profits for so long while central banks cut rates to nil. We're there now. Our own central bank, head was out this week talking about how they're going to keep the benchmark rate at 0.25 for at least another 3 or 4 years. And, we're going to reduce actually the bond buying we're doing from $5 billion to $4 billion a month. But, don't worry, it's all going to be great. He might as well have said, we're completely out of ammunition. We have nothing else to offer on the slashing rates and easing credit side. So that sort of lever has been spent. So we've got that not favorable to expanding leverage and boosting profits going forward. We've got the global recession, the worst since the 1930s, and we've got this need for increasing taxes. So all those things are going to be headwinds in terms of profitability of companies that are already trading at record multiples. So the only way that you can justify anything close to what they're trading for in most cases today is to assume we're going into a panacea of wonderful business opportunity and all the most, advantageous conditions. And in fact, we've got the opposite when it comes to the corporate prospects looking forward. So I'm not saying there won't be businesses who do well in this environment. I'm just saying that the publicly traded companies have really been in a bubble, and they've had these, unsustainable benefits and assistance to their current prices, which are not going to be able to continue. So all of those factors really suggest that the disconnect that happened, the sell-off that began into March really made sense because we were at the end of the global boom, because we had seen so many things top out in terms of the longest expansion in history, and we were due for the recession. Then we get the pandemic that not just brings a recession but an actual depression, and then there's this bounce back period where people think it'll be gone in a couple of months and, everything will be temporarily, any losses will be temporary. Well, here we are coming into the last quarter of the year. We've got still missing at least 1 million jobs in Canada from the 3 million we lost in the first quarter, and now we're into the next shutdown phase, right, Jim? We're seeing that all over the place, where Germany, Spain, France, Canada in many cities, Toronto, our big hubs, they're having to reclose businesses. And this is, catastrophic for many of the small business owners. They're saying, look, we literally can't get through another shutdown, and yet we literally can't afford to have this virus hold us at, its mercy for an indefinite period of time. We have to, in other countries that have taken it very seriously and put, a full-on 3-month lockdown where people can't leave their homes, they've literally been able to eradicate it. In places like Melbourne and various other places. They've been very successful, but they've taken it very seriously. And we've sort of tried to have our cake and eat it too here, much less here than in many places in the United States, and they're paying the penalty for that. So we've got very low, the Canadian Federation of Independent Business came out this week with a sentiment in small business being the lowest since May. And falling the most since last March. So I think we're very much in this second phase period where I was talking about, after the first initial bounce, you get the reality of the cost and the longevity of this episode and how difficult it's going to be to rebuild, jobs, wealth in the economy. And it's not going to be something we can do quickly, and we're going to have to do investment, not quick inflation tricks, but literally investment in the front end, at the expense of present consumption in order to build a brighter picture going forward. So all of that suggests that the repricing cycle on the asset prices that have got so disconnected from that reality has much more to run. And, I think that you're seeing a bounce back today a little bit, but in reality, things like the Canadian banks are still down more than 20%. The energy, the oil companies in Canada, of course, the sector, it's down over 55% in the last year, and the price of oil is back under $36 a barrel. So, I think that the slog continues here. The mean reversion is not yet complete. And it is hard to wait for it to happen. I appreciate that. It takes patience. But the worst thing is to hold things while they drop, right? And to let it grind you down into the bottom of the bear market where most people capitulate. So it's much smarter to be holding things like treasuries, which are actually appreciating in value. Our accounts have been making gains steadily throughout this year. We haven't had any of the volatility. We've had none of the drawdown. And this is how you maintain mental strength to be available to buy when the pricing finally makes sense again. And I think that will happen. I think for sure we may get that opportunity in 2021. But I think from here to there's a lot of losses yet to go.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, do you think the Bank of Canada will lower rates any further? Will we go into negative interest rates?
I don't think they're going to do that as a policy move because it's been tried in other places with such horrendous impacts on bank profits, on insurance companies, on everything that, the whole structure and stability of the financial system is at risk when you start going into negative territory. Perhaps in some theoretical world that makes sense, but in reality it's absolutely devastating, and we've seen that play out all over the place. So I don't think, on a theory basis at least, they're going to be mad enough to try that, although I have been disappointed in the past in how crazy some of the ideas have been. But I think that it's possible that our for example, our government bonds, provincial, municipal, federal bonds in Canada, they have been a safe haven. They've seen inflows. So as money is coming into them this year, the yields or the rate on them has been falling. So we could see that our long rates continue to drop, and the price of existing bonds continue to rise, not in the corporate sector. I'm talking about in the government sector. Today, all the way out to 20 years in Canada, a federal government can borrow for 0.85%. It's pretty amazing, so there's an opportunity there again to raise funds for this long-term investment that is required. But for the individual that's holding these bonds now, they're seeing capital gains. It's not just about the interest rate that's being paid, it's about the actual appreciation in the price of the bond. Now, that's not going to continue forever, and I'm not suggesting that if you own a 10 or a 20-year government bond today that you're going to hold it 10 or 20 years. But I think that in the next few years, potentially just even the next year, as the repricing happens in the risk sector, in the corporate sector, as the rubber hits the road, so to speak, you could see some further gains in what is perceived as the least risk paper. And then you have an opportunity to move some of that money over to things like preferred shares potentially, or corporate debt, which should have fallen significantly. It already has. Again, part and parcel of this crazy lending, lax lending, throwing money at anything with no actual assessment of the risk involved, is that a lot of the debt that's been issued in the last couple of years is starting to go bust now in the corporate sector, especially in the high yield sector. And so-called investors, who are actually speculators because they weren't doing the math, were concerned about return of principal. They were just buying wildly up because yields were low on other safer things. They're really seeing that bankruptcy is wiping out, an incredible amount of the principal that they put forward. We're seeing in some cases pennies on the dollar being returned or left after the restructuring in these companies. So the penalty for not paying attention to price, for not being concerned about protecting your principal, is that you end up losing big chunks of it. And that's happening in the corporate sector. However, after restructurings are complete, there'll be an opportunity to go in and buy some of those bonds at, maybe 50 or 40 cents on the dollar, and then the yield at that point will be very attractive, potentially double digit, for the companies that survive. So again, there's great opportunity coming on the interest rate side, on the bond side. But again, you don't want to be holding them when you're in the midst of this repricing cycle, which is currently going on. And so yes, we could see Canadian rates fall a little bit further as this all this plays out. And then at that point, we should see yields begin to rise again, although I don't think it'll happen quickly.
Danielle, does it tell us something that General Motors announced the sale of their $113,000 American e-Hummer, that giant 1,000 horsepower sideways wheel turning vehicle, sold out in 10 minutes?
Well, yes. I mean, I guess that's good. It's an affluent product. It's a collector's item. There's always going to be a market for that sort of thing. They're way behind the eight ball. They should have been leaders in the EV space, but of course they spent their early lead in the EV1. They crushed those cars when the owners loved them and wanted to keep them, and tried to go back to just producing ICE. So now we've bailed them out how many times in the last 15 years? So I really do hope they get with the EV plan. They say they are, but they tend to be like oil companies. They want to call themselves energy companies, but really they're not investing enough to be the energy company of the future. They're trying to be the oil companies of the past, and we're seeing that with the traditional automakers, where they talk a good talk about their EVs, but then they talk about, no, actually we're going to make more hybrids, which is, the least efficient engine, because you have to do a combustion engine as well as a battery component in the cars. So they really have to just get over that and move into the future, and making a massive, heavy Hummer, I guess is sort of a start, but I hope they get a lot more practical than that.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.